Hey, it's Jim, and this is FRM Part II, the topic on credit risk measurement and management, and the chapter on governance. I typically start with a commentary from the beginning of the chapter, but I'm going to do the opposite, just like George did in that great Seinfeld episode. I'm going to skip to the end of this chapter. The final section is on the Chief Executive Officer and his or her responsibilities. And there's some language in there that I think is a really good exam question. Let me go ahead and share my thoughts with you. Suppose you get a question stem that says something like, hey, the CEO has a chief risk officer, and this individual is super skilled, super talented. There are a bunch of risk committees that are working, and these individuals, they work as a team. They know how to price risk and all that kind of good stuff. And the question might be, it might sound something like, hey, the CEO can delegate that responsibility, but the GARP is really keen on this, and hopefully you'll see this as we go through the slide deck, that the CEO must act as if he or she is directly in charge of risk management principles. So remember that. And I think that's a good potential exam question. So let me go ahead and swing back to the very beginning. Like I normally do, there's a sentence in that first paragraph or two that sounds something like, hey, we're all professionals, and we know that professionals always follow the rules. And I kind of scratched my head on that, and then it dawned on me that what GARP is trying to do here in this chapter called governance, is remove the human element from the process. So there's nothing about behavioral issues. There's nothing about, intentional fraud and misrepresentation. The idea here is to focus on governance, is focus on the protocols and the processes and how these professionals follow them. In fact, there's language in there that says, when typically you do some research and there are massive financial failures, you'll see that the system was at fault rather than the individuals. In fact, they use the word toxic in there. And I had the thought, wasn't that a Britney Spears song from a long time ago? All right, here are the learning objectives. So we're going to do some definitions. So define risk management responsibility. So that's what I was talking about with the CEO must act like he or she is in charge of risk management. And then what are these three lines of defense? We'll do that. Those are super easy questions there. And we'll talk about some processes and then principles, parameters. We'll have, kind of an interesting table that is taken right out of the chapter that I think is a really, really good exam question. And then the roles of credit committees. So let's go ahead and start with, just a simple definition. Hopefully you've heard me say this before. This is kind of my general idea. We need to identify the risks, we need to quantify the risks, and then we need to manage the risk. But what GARP is interested in there, they say identifying. So that's the same as my definition. And then evaluating. And so I always use the word quantify because I like to do math and I like to say, we have this much risk, and however we're measuring risk, whether it's, exposure or beta or some other measure of risk, I want to know exactly what that means. But here in the context of, this book that we're reading, is that evaluating implies things like measuring and then comparing and then seeing at what level we've had over the trend. So evaluating means a little bit more than just quantifying. And then mitigating, that's all part of my word, managing risk. So when you have these risks, you either accept them or you do something about them. And if you want to do something about them, you're probably interested in lessening or mitigating those risks. And so this is an important exam question to understand that process: identify, evaluate, and mitigate. And of course, we're not doing this over the next week. We're doing this over the next, let me just go to the extreme. How about century, right? We want stability and long-term success. The word that I always use, now, especially in my corporate finance class, I teach financial institutions, every now and again, but the word sustainable is super critical here. So long-term success, so what's the goal of the business? Maximize shareholder wealth. How do we do this? We invest in product lines that are going to have sustainable and relatively stable. I don't want to put that label on there. I don't want you to think, stable cash flows, but relatively stable. How about if I couch it in the terms, I don't want to say minimizing volatility because then we could just squish that down to zero and there would be no profitability in that. But managing volatility. So that's the idea behind the term stability and long-term success. So remember what I was saying, that professionals always follow the rules. Well, the rules have to be practical, they have to be substantial, and they have to be easily understood and easily applied. During my adult lifetime, the tax code has gone from being this big to being this big. So is it practical? No. Does anybody understand it? No. Nobody understands taxes and tax liabilities. But there are lots of people out there who claim that they do. And then the last component here in the responsibility vector is we need to figure out, what are the consequences of failing to identifying and quantifying and mitigating and all those kinds of things. And there's a couple of sentences in the reading that suggests, and there's a slide here in a little bit, that, termination of employment ought to be, one of those big matzo balls out there that are hanging, that, hey, if we don't do this properly, then we may lose our jobs. Now, this is what I was saying earlier about the CEO and the human element being removed from this. So this is a point of emphasis here. Individual errors. It's probably not one individual, but it's a collection of failures in the system of the protocols and the processes. So make sure that you approach this from, kind of a non-human standpoint. I don't want to say Arnold Schwarzenegger and the Terminator kind of machine standpoint, but take the human error out of it and say, we're all professionals, we're all trying to do the right thing, and if we follow these rules and it still is a failure, then it's not our fault, it's the process, it's the system's fault. That's the focus here. Remember that for the exams. All right, here are some really good exam questions here. First line of defense. Of course, the very first line of defense is the owner of the business, right? And then it trickles down to the owners of each process. Let's suppose that I'm the risk officer in charge of ATMs. I'll go and see if you guys watch the great show called Jack Reacher. And in one of the episodes, Reacher's standing in line behind a woman who is under pressure. Her children and her car have been kidnapped, and she's taking money out of this. So she's withdrawing money from a financial institution under substantial duress. And of course, Reacher, he saves the day. He beats up all the bad guys, and she gets to keep her money. But there's no Reacher out there for regular old financial institutions, but we need to act like we're that reacher out there. And so if we're the owner of, whatever it is, credit analysis or derivatives or technology, we need to own that, and we need to act as if we own that, and we are the sole owner of that. And that's the first line of defense. Second line of defense is probably a bunch of committees that work out there. You have all these different kinds of committees, and maybe these are just 2 or 3 individuals inside of the financial institution. So GARP calls this the corporate operational risk management function. And so they oversee lots and lots of stuff that goes on inside of the financial institution. And then that third line of defense is that you have a bunch of really, really smart accountants in the back room. How about if we call them internal auditors, who make certain that we do this and this and this according to the laws and the rules and the regulations. Now, I was interested in this chapter because right after there's a discussion on the internal auditors, there's a paragraph on external auditors. So it wasn't clear to me whether those external auditors are included in that third line of defense, but I'm guessing that they are. Let me cover this slide with just a quick example. Let's suppose that I come into your financial institution and I want a loan, and I bring with me one of my colleagues, another finance professor. So I go first. So credit origination, what happens? We sit down, right, and you ask me a bunch of questions. And then you do the risk assessment, and then you either approve. So during that process, I say to you, hey, I'm in my 60s. I've been teaching for 100 years. I have pretty stable income. I got a good retirement. I have lots of assets. I have minimal expenses, et cetera, et cetera. So I'm a good credit risk. So you say, okay, Jim, how much do you want? 100,000, 400,000, whatever it is. So you approve that loan. And then right after me comes another college professor, PhD in finance, just like me. And you look at this individual and you say, oh, this dude, he must be a lot like Jim. I'll just go ahead. How much do you want? 200,000, 300,000. All right, but maybe this guy behind me, maybe he's just a newly minted PhD, never taught before, so his income is not nearly as stable as mine. It's probably not nearly as high as mine. Probably doesn't have any assets, retirement, all that kind of good stuff. So this process here, the credit risk-taking process, involves you guys as good financial institution representatives to work through this process. All right, ready? So notice there's the word process up there. So you originate, you assess, and then you approve. And somewhere inside of that approval, you're going to attach some price of risk. Now, clearly the price of risk for me would be different than the price of, at least I'm thinking it would be different than the price of risk for a 30-year-old new finance professor. And it's up to you to figure out what those differences are. And you may charge me 5% on my loan, and you may lend me $400,000, and you may ask me to pay over 5 years. But when this next dude comes in, you may say, you know what? We're going to lend you money. Maybe it's only $150,000, and we're going to make you pay over 3 years, and we're going to charge you 7%. So that's all this process here. So there are really good exam questions that can be embedded inside of your exam, in which the answers A would be origination, B would be assessment, and 3 would be approval. And then you would identify at what stage of the process you're in. But then the GARP could also ask really good questions about, hey, here's a process. We had Jim in and we had his colleague in, and there was a failure. Jim's colleague failed to meet his payment after 6 months. Where did we fail? Was it origination? Was it risk assessment? Was it the approval process? Those are really, really good questions. Other good questions are here: guidelines, skills, limits, and oversight. So this is a big section in the middle of this chapter here. So what are the purpose of these guidelines? I mean, we know exactly what these best practices are. The purpose of the guidelines are that they should be well written, they should be easily understood and easily applied. And if there is any kind of confusion about this, there needs to be a process that says something like, oh, you go over there to that person way over there, and they'll help you out. So the purpose of the guidelines are for us to be able to be in a position so that we always make the correct decision. And how do we do that? Well, we have methodology that has been approved and been successful in financial institutions for thousands of years. There's delegation of authority. Remember now, the CEO could come in and say, hey, I'm responsible for every decision that is made today. And so, you go knock on his or her door and say, okay, here's this, here's that. I mean, there's no way that's efficient. So remember, we've got really, really talented people at all levels inside of the financial institution. So find their skill set. Now, we haven't done the skills just yet, but find those guidelines, write those guidelines so that we can identify those people with that particular skill that is useful and practical for things like new products, especially derivative securities here. All professional organizations are super big on reviewing and monitoring and updating. And then here, look at that last diamond point down there, failure to follow guidelines. What are those consequences? Now, what happens if there's a breach of those guidelines? So look up at the top of the right. I was warning you about this, employment termination. So that's kind of an extreme case, but what could we do? Clearly, we need to have some kind of an awareness. So in those guidelines and in the process, there has to be the ability of either a human or some technology out there to identify that there has been a breach. Once that breach has been identified, then what are the immediate consequences? And then do we alert everybody? Do we send out this blast announcement that we have a problem? Houston, we have a problem. I mean, it's probably not that big of a deal on a daily basis, but it could be. And then, of course, there's always a paper trail down in that bottom right. Now, this is what I was talking about with skills. Expertise, capabilities, what does that mean? We need to find those. We need to hire those people, first of all, that have those special skills, and those special skills go beyond the technical knowledge. I mean, I have students who graduate who can use Excel and the solver function to find the efficient frontier, the Harry Markowitz efficient frontier. I have students who can price a call option using the Black-Scholes-Merton option pricing model, but they don't have, the soft skills. They don't have the ability to look beyond the technical skills that they have acquired. So you need this combination of, I always call it artistry and math, right? You need these technical skills and you need the artistry to be able to interact with team members, interact with customers, interact with the CEO, interact with all the people out in the line for the ATM. Now look down the bottom left here. That's super important when delegating authority. What do we have over on that right? So complex business operations, there's a good exam question. Market dynamics, regulatory landscape. So you see how that box over there on the right-hand side, that kind of summarizes or coordinates some of the functions of the business connected to the goals of the business and how we can make decisions and assign individuals who are experts in complex business operations, market dynamics, and landscapes. Two-step process in delegating authority. All we're going to do is take a look at these fundamental parameters. Each transaction ought to be matched with, somebody who knows what they're doing. Delegation can be based on these parameters. So we might say something like, hey, here's a credit analysis. So this individual has, this many assets. So there's one parameter, and then another parameter over here might be some kind of an artistic idea behind this. So you say something like, hey, have you ever been late on a mortgage payment? And so that individual says, let's suppose that individual says no. Now you can check that, you can easily check that, but you get a sense of, this person is committed to making those mortgage payments there. Two-step process. So just remember fundamental parameters and then delegation. And so here's this table that I was telling you about, and this is kind of an application of what I was trying to say in that previous slide. So notice what we have down the left-hand column. So these are risk levels from 1 to 6, 6 being the least. And then we have this exposure, and there are 4 columns. Notice that the exposure increases over as we go from left columns over to the right column. And then down at the bottom, who do we need to get involved? Where is the delegation? Does the CEO need to be involved? And so think about this as, almost like a sliding scale. So imagine somebody comes into the financial institution and says, hey, I need a $1 million loan, and I want to take the short position in 500 oil futures contracts. Let's just take those two simple examples there. So we got two different things. So what's going to happen is that someone is going to have to assign an internal rating of that counterparty. Now, maybe that internal rating might be identical for the loan and the derivative position, but maybe it'll be two different ratings. So you just go from R6, which means that anybody could make this decision. Think of an intern, a college intern who works 10 hours a week. That would be the lowest form, and then slide that all the way up to the CEO. Think of this table as kind of that sliding scale. Now I give you extreme examples there, and so this is right out of the chapter. So head of trading. So if we have relatively low risk exposures, then one individual or maybe some groups of individuals can do that. Maybe we have a transaction committee then as we start to get into the higher risk levels, and then we need some executive risk committee, and maybe the chief risk officer is involved in that far right column. So look up at the top right, R1 600, that's the exposure. Now we don't know anything about tenor here. It says up to 5 years, so you probably would have, different layers inside of each one of these rows and columns. You'd probably have one for a 1 year and maybe 2 and a 3, or maybe you'd group it into 1 to 2 and 3 to 4 and then 5 years. So there are all different sorts of ways that you can apply this delegation of authority to this credit risk governance. So think of it as a sliding scale. And let me just do it, a brief summary here. So all the way at that top right, R1 and 600, that's super risky. So we want our most super talented people making that decision. All the way down on the bottom left, there's just 50, so that's least risky. So we can have, what did I say earlier? An intern. We probably don't want an intern, but you see what I mean about that sliding scale. So this is probably a really good example. So the answer on the exam would be, well, just where do you want to stop? Where do you want to stop that sliding scale? And this table gives you some kind of a good sense of how to answer that. Of course, we need to put limits on this. Back here, we don't have any limits, but what we could say in one of those columns, we could say R1, we might have a limit of 425 or 625 or whatever that might be. We need to have limits on counterparties. We need to have limits when we're cross-border, right? And we need to have product-specific limits. And this is super important for derivative security. So what did I say? When I was setting up this problem, I came in and I wanted a loan, and I wanted to take, what did I say, the short or long position in oil futures contracts. So, maybe I'll say I want 500 short, and you might say, well, we have a limit of 200, especially you, Jim, right? You're a college professor. What do you know about oil futures contracts? So it's super important to establish these limits. So good exam questions would be, why do we have limits? And the answer would be, oh, well, look at this here. We just measure riskiness and exposure. That makes perfect sense. And what we're trying to do is we're trying to navigate through this risk mitigation. So this is one of those mitigating risk ideas. Now, this is what I was saying earlier about the difference and the complementation of, is that a word, of art and science. I called it math earlier. And so what we need to hire lots and lots of individuals and groups of individuals who can work together, who can apply some kind of a model. What did I just use earlier? I used the Black-Scholes-Merton option pricing model. Of course, we need individuals who know the inputs, who understand the inputs, but we need to use judgment. We need to use our own experience. We need to use an idea of internal and external factors. We need to say something like, I'm making a decision today, but tomorrow I might make a different decision. So that's why we have these, frequent adjustments, varied limit types. So that limit could be this much today, might be this much tomorrow, and that depends on, the regulatory framework. It depends on the market dynamics. It depends on laws and rules and regulations, and it depends on the board of directors who have established, some kind of limit on acceptable risk levels. Look down at the bottom there, of course, real-time tracking. That makes perfect sense. Let's move to this last part of the chapter on the role of the CEO. This is what I've been trying to emphasize throughout here. So it's the real head. So that's why GARP puts this in quotation marks, because you might think that the chief risk officer is the real supervisor of risk management, but of course, it's the CEO who's responsible for everything. Yeah, strong risk management culture. You've heard me say this. You've heard me say this before. At least I hope you've heard me say this before, that it's the responsibility of the board of directors to create, to identify, to establish some principles of risk management culture, and then make certain that those things pervade, is that the right word, throughout the organization, so that every day when the employees show up for work, they're thinking about risk. How about these parameters? And I hinted around these just in a couple of slides ago. So the amount of exposure, this is essential for risk quantification. There's my quantifying risk. Credit quality, there's a summary scale. So that's what I was saying, that moving slide rule or that moving scale. And then the tenor, and by the way, not that you guys care about this, tenor, that was the term used for the maturity. It still is used for the maturity of a swap contract. And so that term has been, kind of used by lots and lots of different people. So tenor, duration of the exposure. There's an interesting sentence inside of this chapter that sounds something like, the credit risk of a loan is the duration of and the tenor right up until that final principal payment has been made. And so think about that. A loan. Suppose I come into your financial institution, I borrow 100, and I make these regular payments. So the exposure falls and falls and falls, and then the tenor gets shorter and shorter. If it's a 5-year loan, and I make the first how many months is in 5 years? I make the first 48 or 50 payments. Well, then you're down to pretty low risk. And so that affects the risk profile over time. Make sure you can do that on an exam. All right, this credit committee, that credit committee is in the, here, let me go back here real quick. Can I go all the way back here to that? So these credit committees here, they're down, somewhere in the bottom right. And by the way, I think I said this earlier, but it's probably worth repeating, is that you don't have to have just 4 columns. You could have 50 columns. 50 is probably too many, but you could have multiple columns. So what's going on here of this credit committee? Approval, oversight, that makes sense. Risk management, support. So remember earlier I said, we have this idea, here's an issue, we're not quite sure where to go. Let's go to somebody over there. Well, that's probably what we're going to do. We're going to go over to that credit committee. They'll know everything. And of course, the credit committee is probably responsible for writing the governance document and researching the governance document, which means that they have the best ability to enforce the governance document. What we want to have on these committees is that we want people who have unique talents so that we combine them. I think the great question here, look at the bottom, risk management, legal, tax, compliance, accounting. You could throw a bunch of other stuff in there. You could have derivatives, you could have credit analysis, you could have everything in there. But think about this. If you have 4 people in the credit committee, you want to say something like 1 + 1 + 1 + 1, that equals 4 people. But if you add their skills, 1 + 1 + 1 + 1, and then you combine their skills, you compound, if I can use a time value of money concept, you compound those skills so that when you add those 4 individuals together, you get 5 or 6 or even 10. So that's this expertise that GARP is emphasizing in this chapter. Approval package, so this is an obvious notion there. Committee governance, this is all part of the governance structure. I've said this to you guys before. You think of governance as an umbrella, and so you have the CEO outside of the umbrella, and then you open the umbrella up, and you have all these different kinds of committees. Somewhere up at their top is the chief risk officer, but they're all part of the umbrella, right? You can't have the umbrella unless you have all the different parts. So where each committee is just one component. And so this is where, and we've talked about this before, and we'll do this in future chapters here in part 2, that, hey, this is super important. Remember, we've talked about, and we're going to continue to talk about not just correlation coefficients, but copulas and all of those interrelationships that are super important. We want to, what did I say earlier? We like to review, we like to monitor, we like to edit, we like to manage, and so we're going to record. So make sure that you record. Over the years, I've sat on a bunch of committees at my college, and I never raised my hand to be the secretary to keep the minutes of a meeting because I don't want to have to pay attention during the entire meeting. Oh my gosh, did I really just say that? But B, I have terrible handwriting, and I don't really want to do that. So that takes us through these learning objectives. So I think I've emphasized some good potential exam questions. So thanks for watching. Have a great day and good luck studying.